Good evening, dear students. Very good evening, everyone. How are we all? So we're just approximately couple of months to face the CA inter exams, and right now this evening, this Sunday evening, we are assembling here for quickly revising the topic of ratio analysis, right? So we are assembling over here to revise, to recap the ratio analysis. Fairly easy chapter, but the questions can be, quite tricky sometimes, right? So we can say the questions are typically going to be easier, uh, provided we are through with the concept. So right now, let me just set the tone or agenda for the today's session. Okay. So, well, the agenda for today's session, guys, is going to be, first we will be revising the ratios quickly. And after that, we'll be looking at certain case scenarios from the topic of ratio analysis and certain questions also. Okay. So let us quickly recap the ratios. I want it to be interactive. So you can just interact with me through the chat, okay, through the chat box. You can interact with me. So we will be, it will be making us, making the things more clearer for us. Okay. So are we good? Are we there, everyone? Are we there with me, everyone? Everyone? So we have Abhishek, we have Shriji, Akam, and Kavya. Are you all there with me? All of us. Abhishek, Shriji, Akam, and Kavya. Well, Shriji is there. He has said a good evening to me. I don't know about others. Are we all there? Abhishek, Akam, and Kavya. Yeah. Okay. Anyways. Okay. So Kavya is also there. Akam is there. Okay. Abhishek is also there. Interesting. Interesting, guys. Okay. So let's go ahead with the ratio analysis. Ratio analysis, let's look at certain ratios based on which we would like to obviously solve certain questions. Let's do it this way. Um, I'll ask you a question on ratio analysis, and you guys are supposed to answer me the ratio. Okay, without looking into the book, right? So I just expect that level of diligence from you all. I'll be putting up the question like the ratio, and you're supposed to answer, that ratio, right? So let's begin. First thing, current ratio. How do we compute the current ratio, guys? Come on, tell me. How do we compute the current ratio? Perfect. It's current asset upon current liabilities. Perfect. Achha. So in current ratio, we know it is higher the better. In current ratio, we know that it is higher the better. But then the point is, when you say that the current ratio is going to be higher the better, but does it mean that very high current ratio is good? No. So very low current ratio is also not good. So what can we say about the ideal current ratio, guys? What's the ideal current ratio? Ideal current ratio, perfect. 2:1. So ideal current ratio is 2:1. Okay, then tell me what's the formula for quick ratio? What's the formula for quick ratio, guys? Quick ratio. Quick assets upon current liabilities. Okay, but can you just elaborate what is quick asset? Can you elaborate what is quick asset? Quick asset will be your current asset minus stock minus prepaid expenses, right? Upon current liabilities. Then, what is absolute liquid ratio? By the way, quick ratio, we also known it as uh, quick ratio, or we also call it as liquid ratio, right? And there's another name to this. There's another name to this, which is called as the acid test ratio, right? Okay, so then we have absolute liquid ratio. absolute liquid ratio, which is also said to be, uh, cash ratio. Can you tell me what's the formula for this? What's the formula for absolute liquid ratio or cash ratio? Absolute liquid ratio or cash ratio? We'll be including only cash plus cash equivalents upon current liabilities, right? Okay. Then tell me what is the next ratio, which is, let's say, debt equity ratio. What's the debt equity ratio, guys? What is the debt equity ratio? I know it is debt upon equity, but what all do we have in it? We have the debt, or which we call it as the borrowed funds. Borrowed funds, debt or borrowed funds upon debt or borrowed funds upon. So we have like equity share capital plus reserves, right? Minus any fictitious assets. So we have debt, which is borrowed funds upon equity share capital plus reserves minus any fictitious assets. Okay. Then tell me what is proprietary ratio, or you may also call it as, let's say, equity ratio. What is equity ratio, guys? Proprietary ratio or equity ratio? What's the formula for proprietary or equity ratio? It's of course equity share capital plus reserves minus any fictitious assets upon total assets. Perfect. Okay. Then tell me what is capital gearing ratio. Tell me what's capital gearing ratio. Capital gearing ratio, guys. What is capital gearing ratio? Capital gearing ratio. Any idea, guys? What's capital gearing ratio? What's capital gearing ratio, guys? Debt plus capital gearing ratio is debt plus preference share capital upon equity share capital plus reserves minus any fictitious assets. Correct? Preference share capital plus debt, or which is obviously debt when we say it's a long-term thing, and then equity shareholders fund. Perfect. That's your capital gearing ratio. Then let me ask you one thing. Yeah. Return on capital employed. Return on capital employed. Return on capital employed. What's the formula for return on capital employed, guys? Return on capital employed. What's the return on capital employed? Okay, perfect. We have EBIT upon capital employed. So which is EBIT upon capital employed is yeah, it should be average capital employed. Perfect. So when I say average capital employed, it's going to be average of equity funds plus borrowed funds, which is owned funds and borrowed funds. So return on capital employed is EBIT upon average of equity funds and borrowed funds. Okay, that's your return on capital employed. Now, if I ask you what is return on equity? What's the formula for return on equity, guys? Return on equity. Anyone? Return on equity? What's return on equity? Return on equity. It is earnings available for equity shareholders upon equity shareholders fund. And we know what's equity shareholders fund? It's equity share capital plus reserves minus any fictitious assets. Okay, that's your return on equity. Okay, now tell me what is GP ratio? GP ratio, gross profit ratio, guys. What's the formula for gross profit ratio? GP upon net sales. Then net profit ratio. Net profit ratio. What is net profit ratio? Net profit ratio. It is going to be net profit upon net sales into 100, right? Okay. Then can you tell me what is operating ratio? Operating ratio, guys. What is operating ratio? What's operating ratio? Anyone? Operating ratio. EBIT upon net sales. No. I'm not asking you operating profit ratio. I'm asking you operating ratio. Operating ratio is going to be COGS plus operating expenses upon net sales. So that's going to be COGS plus operating expense upon net sales. Okay. Okay. Then some of the other ratios, like I'll ask you, yeah. What is inventory turnover ratio? What's inventory turnover ratio? Inventory turnover ratio. Inventory turnover ratio. Perfect, guys. COGS upon average inventory, right? Then if I ask you what is the inventory holding period? How much is the inventory holding period, guys? Inventory holding period. What is the inventory holding period, guys? Yeah. Inventory holding period. Perfect. 365 upon inventory turnover. Then what is debtors turnover? Debtors turnover ratio. How much is debtors turnover ratio? Debtors turnover. Yeah, perfect. This credit sales upon average debtors. Acha, but I call this average debtors to be with a star or asterisk because we need to understand that average debtors are definitely going to include something else also. So remember, average debtors will be, I mean, instead of saying debtors, we should say it as normal debtors, receivables. But we can say it includes your average trade receivables plus the bills receivable also. Okay. Now, What is debtors collection period, guys? Debtors collection period. Debtors collection period. How much is debtors collection? 365. Perfect. 365 upon debtors turnover. Okay. Same way, what is creditors turnover? Creditors turnover. How much is creditors turnover? Creditors turnover is creditors turnover. Creditors turnover. It is credit purchase upon average trade payables plus average bills payable. Both of them are going to be there. Similarly, creditors collection period is going to be 365 upon creditors turnover. Okay. Now, if I ask you what is a fixed asset turnover ratio, tell me what's fixed asset turnover ratio? Fixed asset turnover. Fixed asset turnover is what is fixed asset turnover? Sales upon average fixed asset, you can say, right? Sales upon average fixed asset. Okay, so that's your fixed asset turnover. Now let's go for some of the market ratios now. How do we calculate the earnings per share, guys? Earnings per share. Earnings per share. Earnings per share. It is earnings available for equity shareholders upon number of equity shares. Okay. Then what is dividend payout ratio? Dividend payout ratio. What's dividend payout ratio, guys? Dividend payout ratio. Dividend payout ratio. Yes, it's dividend per share upon earnings per share. Dividend payout ratio is dividend per share upon earnings per share. And what is retention ratio? What is retention ratio? Retention ratio, guys. Retention ratio is nothing but 1 minus dividend payout ratio, right? Then what is earnings yield? Earnings yield. Earnings yield. Earnings yield. Earnings yield is earnings per share upon market price per share. Then what is dividend yield? Dividend yield, guys. Dividend yield is dividend per share upon market price per share. Dividend per share is what? EPS upon MPS. Got it, everyone? Okay. Now, so these were some of the ratios that we would likely, revise certain things. Now, let me just put up a warm-up question for you. Suppose we have a current ratio of 1.5. Current ratio is 1.5, and we have the working capital number. Working capital is 3,75,000. So working capital is 3,75,000, right? Current ratio is 1.5, and I'm saying that quick ratio is 1.2. Okay, I want you to calculate uh, value of current assets, then what's the value of current liabilities, okay, and then the value of the stock. Would you like to solve it, everyone? Would you like to solve it on your own, or shall I just give the solution to you? Yes, you'll solve it. Good. Go ahead, guys. Go ahead, guys. Okay, I got the answers. Okay, so let me quickly solve it for you. So we know current asset upon current liability is 1.5. So we can definitely say current asset is 1.5 times of current liabilities, guys. Then since working capital is 3,75,000, we can say current asset minus current liability is 3,75,000. Current asset is 1.5, current liability minus current liability is 3,75,000. So 0.5 current liability is 3,75,000. So we have got the current liability as 7,50,000. So current liability is 7,50,000. Okay. So you've got the current liability as 7,50,000, guys. And similarly, we'll get the current asset as 1.5 into current liability. So that's 1.5 into 7,50,000. So 1.5 into 7,50,000, that's current asset is 11,25,000. And then we have a quick ratio. Quick ratio given to us is 1.2. So quick ratio is 1.2. And this 1.2 is current asset minus stock upon current liabilities. So 1.2 is 11 lakh 25,000 minus stock is something which we don't know upon the current liability of 7 lakh 50,000. Okay. So this gives us a stock value of how much, guys? What's the stock value? Stock value is 2 lakh 25,000. Stock value is 2 lakh 25,000. Perfect, guys. Okay. Then let us take up few questions or case studies maybe for the discussion of ratio analysis topic. Okay. Now let me just put up a question in front of you. Mhm. Okay. So here we have this question. From the following information pertaining to Mrs. Anya Company Limited, prepare its trading P&L for the year ended 31st March and also a summarized balance sheet. So we have certain ratios given to us and we have to compute the balance sheet P&L, right? Trading P&L and the balance sheet. So can you solve it? Yeah. Can you solve it, guys? How much time would you need to solve this? So going by the exam standards, let me just give you for this, 12 minutes should be sufficient, including the reading time. So let's just try to solve it quickly, guys. Try to solve it quickly. Okay. How many of you are done? Is anyone done with the answer? Yes. Is anyone done? Okay. Part of it. Okay. So let's just use these ratios and quickly try to decipher the answer. So we have the current ratio is 2.5, and we know this is current asset upon current liabilities. This simply says that current asset will be 2.5 times of current liabilities. So this is our first equation. Then connected with the current ratio, we have a number called as the working capital, right? So let us calculate the working capital. So working capital is current asset minus current liabilities. So that's given to be 1,20,000 days, right? And then when you're solving these two, 1 and 2, you'll be able to get current asset and current liabilities. Current asset and current liabilities. Now, what is the value of the current asset and current liability, guys? Current asset is 2 lakh. Current liability is 80,000. Correct? So current ratio is 2.5. Quick ratio is 1.3. Now let's look at the quick ratio. Quick ratio is 1.3. Quick ratio is 1.3. This is simply your current asset minus stock upon current liabilities. So we know this is 1.3 is equal to current asset is 2 lakh minus stock is something we have to calculate. Stock upon current liability of 80,000. This will give us the value of the stock. What's the value of the stock? 96,000. Perfect. Value stock is 96,000. Then there were the stock. Then we have the working capital, sales, share capital now. Uh, Bank overdraft, gross profit to sales ratio. Then we have the debtors velocity. Gross profit to sales ratio is not something that we can use. Now the next ratio that we have to use. How do we get the debtors? We have the working capital 1,20,000, bank overdraft is 15,000, share capital is 2,50,000. Now we just have this quick ratio. Now in this quick ratio, we'll have definitely that all sales are on credit if we assume. So if we have the sale value, all sales are on credit. So if you assume that, then we have got this debtors velocity to be 40 days and sales is given. Of course, we can say all sales are on credit. So we can say debtors velocity, which is debtors velocity is equal to debtors. Sorry, it's going to be what? 365 because it is given in days, right? 40 days. So 365 divided by debtors turnover. So this is 365 divided by debtors turnover. So when we say debtors turnover, it's going to be I mean 365 upon debtors turnover is not given to us. But yes, we can calculate this as 365 upon sales divided by the value of the debtors. Right? So this is 365 upon sales is 7,30,000. Sales is 7,30,000 divided by the debtor value. And we want this number to be equal to what? Debtor's velocity is 40 days. So this is 40. Solving this, we can get the value of the debtors, guys. What's the value of debtors? Just check if it is 80,000, guys. Is the value of debtors 80,000? Just check. So it will be 365 by 40, and then that multiplied by 730 upon, yeah, so debtors should be 80,000. So we got the stock, we got the debtors, we've got the current asset, we've got the current liabilities. Now the next thing that we can use is gross profit to sales ratio. This will give us the value of gross profit. So gross profit will be 10% of sales, which is 7,30,000 into 10%, which is 73,000, right? So gross profit is 73,000, debtors velocity is used, sales is used, working capital is done. Okay, bank overdraft is just a component, share capital is 2,50,000. Now, this in closing stock is 10% more than the opening stock. Now, of course, this stock that we have, it is a closing stock. So what will be opening stock? Opening stock. What about the opening stock? Closing stock is 96,000, and they're saying the closing stock is 10% more than the opening stock. So if it is 10% more than the opening stock, so stock is 96,000, which is the closing stock. Now the closing stock is 10% more than the opening stock. So this is basically 110%. So 96,000 divided by 110%, which will be 87,272. 87,272. That's your opening stock. And we've got the closing stock as 96,000. Then bank OD share capital and everything is net profit is to be computed. Yes. So what is the net profit number? Net profit. Net profit is 10% of proprietary funds. Now net profit is 10% of proprietary funds. Now, of course, this something called as a proprietary ratio over here. They're saying fixed asset upon proprietary ratio to be 0.6. Right. Now, how do we get this? Right. Net profit is something 10% of the proprietary funds. We don't know what's the net profit over here. Neither we have the idea of the proprietary funds. But this ratio, fixed asset to proprietary funds, is given to be 0.6. So how do we go about calculating the fixed asset now, guys? And net profit for that case? Now, first, 10% of proprietary funds, when we say, it's obviously going to be only the share capital over here. So we can say net profit is 10% of 2,50,000. 25,000, right? So net profit is 25,000. So net profit stands as what? 25,000, guys. Now, let us prepare the draft balance sheet and the P&L. So sales is 7,30,000. Less COGS, which will give us a gross profit. Gross profit is 73,000. No. Yeah, gross profit is 73,000. So COGS is going to be how much? 6,57,000. Then we will say from this, other expenses will be subtracting, and then we'll get the net profit. Net profit is 25,000. So 73,000. 73,000 minus 25,000, 48,000. That's your other expenses. Coming to the balance sheet side, we have got the fixed asset. Basically, proprietary asset to fixed proprietary fund. Sorry, fixed asset to proprietary fund is 0.6. So we get the fixed asset as 0.6 into 2 lakh 50. 0.6 into 2 lakh 50,000. So 2 lakh 50,000 to 0.6, which is 1 lakh 50. So fixed asset is 1 lakh 50,000. Then we have the total current asset to be 2 lakh. And then in this we have got the stock, we've got the debtors and other current asset. So stock is 9 lakh 60, debtor is 80,000. Stock is 96,000, sorry, debtors is 80,000. And then what will be the other current assets, guys? 96 plus 80, that is 176. So other current assets is 24,000. Equity is 2 lakh 50. There's no bank loan as such, but we can definitely say current liability has got a value of 80,000, right? Then we have got the um, bank overdraft of 15,000. So we've got the OD as what, 15,000. Other current liability is 65,000. Okay, so 250 and 80 is the balance sheet tally. So balance sheet is tallying or no? How do we get it done then? Yeah, not tallying. Then how do we get it? 20,000 out of 20,000 in liability. Yes. Yep. Net profit 25,000. 20,000 short of 20,000 in liability. Okay. 1 second. I'll just put the. Then this is the question. Just a moment, guys. Was there some line missing in the question or what? I'll just check that. 2A. Okay, so we have got the net profit to be net profit 25,000. We took it, assuming that there's no reserves, you know. But then what we observe is that this is not tallying if I just look at it that way. In fact, the fixed asset number is also questionable now. So these items are something, we can't be accepting as it is. So there is some sort of reserves which we have. So first, if we were going to just prepare this, I mean, for the fixed asset to proprietary funds. So you can simply look at it the other way around. We cannot be doing it this way, guys. So we are going to change this net profit and also the fixed asset number. In fact, the share capital numbers are also going to change. In fact, these other expenses are also going to change. Now, let me just put it the other way around, which is the ratio that we have is net profit is 10% of proprietary funds. That's a separate thing. But when you say proprietary ratio, here they're saying it's fixed asset upon proprietary funds. So it is fixed asset upon proprietary funds is 0.6, right? So we know that fixed asset is going to be 0.6 of proprietary funds. And this proprietary funds is going to be share capital, which is given in the question, share capital of 2,50,000 plus the reserves. So it is 2,50,000 into 0.6, which is 1,50,000 plus 0.6 times of reserves. So fixed asset, we'll call it as 1,50,000 plus 0.6 times of reserves. And then we say equity is this 25. Equity is what? 2,50,000. And we need the reserves value. Right? Reserves is something that we don't know. Now, of course, total assets is equal to total liabilities, right? So total assets is going to be what? Fixed asset, which is 1,50,000 plus 0.6 times of reserves, right? This is of fixed assets upon, sorry, I mean, plus the current assets of 2 lakh is equal to liability side is going to be current liability of 80,000 plus 2,50,000 plus reserves. So you can solve this equation and give me the value of reserves, guys. Solve this equation and give me the value of reserves. Because reserves is obviously going to be part of our current ratio. And it's not current ratio, the proprietary ratio. So I need to calculate the reserves first by equating the balance sheet. So solve this and give me the value of reserves, guys. Give me the value of reserves. Calculate the value of reserves. What's the value of reserves? 50,000? Is it? You just bring all the reserves on one side and the reserve numbers, so 0.6, add to it. So this becomes what, 0.4, 1 lakh 50. Plus this, so is the reserve 50,000, guys? Are we getting the reserve 50,000, everyone? Reserves 50,000. Okay. So once we have the reserves as 50,000, my fixed asset is also going to get calculated. So fixed asset is 0.6 into 2 lakh 50 plus 50,000, which is 3 lakh into 0.6. So 3 lakh into 0.6 is going to be 1 lakh 80,000. So fixed asset is what? 1 lakh 80,000. And I think now the balance sheet should tally at 3 lakh 80,000, right? Then you subtract the other expenses and then the net profit. So net profit is, anyways, it is 10% of the proprietary fund. So proprietary funds is 3 lakh. Of that 10%, which is 30,000. So other expenses amounts to 43,000. So the value of other expenses is 43,000. Got it, guys? Got it, everyone? Are we getting this solution? Balance sheet and PNL. Why we not add net profit in balance sheet? Shriji, net profit is already included in these reserves, right? Your net profit of 30 is what is already included in the reserves. Therefore, we're not adding it. Got it? Okay. Now, let us take up one more question. Okay. So let me just take this one. So let us say the working capital given is 2,40,000. Bank OD is 40,000. Fixed asset to proprietary funds is 0.75. Reserves is 1,60,000. Current ratio is 2.5 and quick ratio is 1.5. Prepare the balance sheet. So in balance sheet, you will have fixed asset, current asset. Again, in that current assets, you will have stock, fixed asset, current asset. Then you have the stock, then other current asset. Then you have the equity share capital, reserves, current liability. In that you have bank OD, other current liability. Can you solve this? I'm giving you the information and also the balance sheet format. Can we solve it, guys? Yes? Okay. So for that, let me just give you some smaller time. Say 9 minutes is okay, 10 minutes is sufficient for this. Sure. Solve it, guys. 10 minutes. Okay, so it's done by Abhishek. Great. Okay, done, everyone. Okay, then so we have like what working capital and current ratio. So working capital of 2 lakh 40, current ratio of 2.5. So working capital 2 lakh 40, current ratio of 2.5. So what will be the total current asset, guys? Total current assets and total current liabilities. Yep. How much is the current assets, current liability? Current asset is 4 lakh and current liability is 1 lakh 60,000. And quick ratio is 1.5. So that gives us a stock of how much? Stock of what 80,000. Stock is how much? Quick ratio is 1.5, right? So stock is what 1 lakh 60. Okay. So other current asset is 2 lakh 40,000. And then we have bank OD as what 40,000. Other current liability as 1 lakh 20,000, right? Then reserves is given as 1 lakh 60,000. The only thing is left out is equity share capital and fixed asset. So you can take equity share capital plus 1 lakh 60,000 plus 1 lakh 60,000 is equal to 4 lakh plus fixed asset to proprietary funds. So we have fixed asset to proprietary funds as 0.75. So fixed asset will be zero point 0.7 into equity share capital plus 1 lakh 60,000. So this will be 0.75 into equity share capital plus 1,60,000. So we have equity share capital plus 3,20,000 is equal to 4 lakh plus 0.75 equity share capital plus 0.75 into 1,60,000, which is 1,20,000. Take all equity share capital on one side. So this will be 0.25 equity share capital is equal to 4 lakh plus 1,20,000 plus 3,20,000. So not plus, it will be minus. So 0.25 equity share capital is equal to so that's 4 lakh plus 1,20,000 minus 3,20,000, which is 2 lakh. So what's the equity share capital, guys? 8 lakhs. Equity share capital is 8 lakh. And then we have fixed assets as 75% of 9,60,000. So 9,60,000 into 75%, which is 7,20,000. Right? And the balance sheet tallies at what? 11,20,000. Balance sheet tallies at what? 11,20,000, guys. Did we get these answers? Everyone? Did you get this? All of us? Fixed asset 7,20,000 and share capital of 8 lakh. Okay, great. Fine. So let's just stop here for the short break right now. And let's take a break of around 10 minutes. And after that, we'll take up a couple of more questions to solve from the ratio analysis. Okay, guys. So let's take a break, guys. Okay, so we will back. I will back, sir. Everyone, are we there? Yes. Yes. Okay, fine. So let's take up the next question, guys, for the ratio analysis. Okay. Okay. So look, we have a question given us wherein we have the information as on 31st March 2023 and 31st March 2024. So here we have the share capital, reserves and surplus, and long-term loan. Net profit ratio is 8%, gross profit ratio is 20%. Long-term loan has been used to finance 40% of the fixed asset. Stock turnover with respect to cost of goods sold is 4. Debtors represent 40 days sales, and the company holds cash equivalent to 1.5 months cost of goods sold. Ignore taxation and assume 360 days in a year. You are required to prepare balance sheet as on 31st March in the following format. So we have share capital, reserves and surplus, long-term loan, and sundry creditors. We have fixed asset, debtors, closing stock, and cash in hand. So to prepare the balance sheet as on 31st March 2024. So would you like to solve it, or you want to answer directly? Will you try it? Want to try? Okay, fine. So let me just put up a timer again for you. Now this time it is 9 minutes. Yeah. Go ahead, guys. Give it a shot. Okay, let us proceed. EPL Limited has furnished the following information relating to the year ended 31st March 2023 and 2024. Now we have to prepare the balance sheet as on 2024, guys. So let me just have the draft balance sheet here. Okay, wherein we'll just write down whatever information is available for us. First up, fixed asset, then the sundry debtors, then we have the closing stock and cash. And on this side, we have share capital, reserves, long-term loan, and creditors. Okay. So as on 31st March 2024, we have the number of share capital, which is 50 lakh. Reserves is 25 lakh. Long-term loan is given as 30 lakh. Okay. Now, rest all numbers we have to compute. Now, the first number as an input that we have is the net profit ratio is 8%. So we have the net profit ratio as 8%. Net profit ratio is 8%. So this is going to be 8%. It means it's going to be 8% of sales. Can you guys tell me what is the net profit amount, by the way? What's the amount of net profit, guys? Can you tell me what is the amount of net profit? Yeah. What is the amount of net profit? Unable to calculate the sales value. Really? Look at the reserves and surplus figures. 20 lakh and 25 lakh. Now tell me, why would have reserves and surplus increase from 20 to 25 lakh? You haven't issued any equity shares, so there's no question of share cap. I mean, the securities premium. But when you say the reserves and surplus has increased from 20 lakhs to 25 lakh, it simply implies what has happened. Can the company is having a profit of 5 lakh, right? So 8% of sales is essentially 5 lakh. So what's the value of sales, guys? So value of sales will be 5 lakh divided by 8%, right? So sales is how much? 62 lakh 50,000. Sales is 62 lakh 50,000. Correct, guys? Value of sales is what? 62 lakh 50,000, right? Okay, we got the sales. Now we can look at like what? Net profit ratio is 20%. Sorry, gross profit ratio is 20%. So we'll get GP as 62 lakh 50,000 into 20%. So how much is the gross profit, guys? How much is the gross profit? 12.5 lakh. Now, since we have this as gross profit, what will be COGS? COGS will be sales of 62 lakh 50 minus gross profit of 12 lakh 50. Right? So COGS is 50 lakhs. Okay. Stock turnover is given. Stock turnover with respect to cost of goods sold is 4. Stock turnover with respect to cost of goods sold is 4. So we have the stock turnover ratio. Stock turnover is 4. Now stock turnover is calculated as what? COGS upon average stock, which is 4. So therefore COGS is 50 lakhs divided by average stock is something we have to compute. That's equal to 4. So what's the value of stock, guys? 50 lakh divided by 4, which is 12 lakh 50,000. Stock is 12 lakh 50,000. Got it? That's done. Now debtors are representing 90 days sales. So we have the debtors collection period. Debtors collection is 90 days. So how do we calculate these 90 days of debtors? How do we calculate the debtors collection period of 90 days? Can I say it is sales upon debtors turnover, which is nothing but sorry, not sales, my bad. This is 365. Has the question specified any specific number of days to 360 days? So we have to take 360 days. So 360 divided by debtors turnover, which is nothing but 360 upon sales divided by the value of debtors. So we have 90 is equal to 360 divided by sales is 62 lakh 50, right? This divided by the debtors. So can you tell me what's the value of the debtors? What's the value of debtors from this? What's the value of debtors? 15 lakh 62 500, right? Okay, so debtors 15 lakh 62 500. So 15 lakh 62 500. Debtors is done. Then the company holds cash equivalent to 1.5 months cost of goods sold. So we can definitely get the cash over here. Cash will be 1.25 by 12 into COGS. Sorry, 1.5 months. So 1.5 into COGS. COGS is what? 50 lakhs. 1.5 by 12. So that amounts to 6 lakh 25,000, guys. Cash. We got cash of 6 lakh 25,000. Okay. Then what we have is fixed asset and information about the fixed asset. Long-term loan has been used to finance 40% of the fixed assets. So basically, long-term loan is representing 40% of fixed asset. Long-term loan is 40% of fixed asset. So long-term loan is 40% of fixed asset. So we have long-term loan as what? 30 lakhs. So this 30 lakhs is 40 by 100 into fixed asset. So fixed asset will be 30 lakhs divided by 40%. So how much is fixed asset? So that is 30 lakh divided by 40%, which is how much fixed asset is? 75 lakhs. So we got the fixed asset as 75 lakh. So how do we get the creditors now, guys? So balancing figure will be creditors. So tell me what's the creditors value? What's the value of creditors, guys? The balancing figure. How much is the balancing figure? Creditors value. Fixed asset calculation. Well, the question says that long-term loan is 40% of fixed asset. So long-term loan was 30 lakh. So 30 lakh was representing 40% of fixed asset. Right? So therefore, this 30 lakh was representing 40%. Therefore, fixed asset is 75 lakh. Creditors, what's the balancing figure? Creditors, guys? 4 lakh 37,500. Balancing figure of creditors 4,37,500. Is it? Did you get it, everyone? Yes. Okay. Let's take up the next question. Change in reserves and surplus. Okay. That was missed by you. Okay. Just wait. Let us take another question. Okay, let's take up this last question for the day. Okay, from this information, you have to prepare the balance sheet. Let me just quickly explain this to you, then you can solve it. So we have the position as on 31st March 2023, wherein we have the share capital, working capital, bank OD, current ratio, liquid ratio, proprietary ratio, cost of sales is given to us to be 14,40,000. Okay. Cost of sales is 14,40,000. Debtors velocity is 2 months. Stock turnover based on cost of sales is 4 times. Gross profit ratio is 20% of sales, and net profit ratio is 15% of sales. So closing stock was 25% higher than the opening stock. There were also free reserves brought forward from the earlier years. Current assets include stock, debtors, and cash only. Current liabilities and expected bank overdraft are treated as creditors. Expenses include depreciation of 90,000. So we have got a depreciation amount of 90,000. Following information collected on the records for the year ended 31st March 2024. Now they have the sales figure which is 20% higher as compared to previous year. Balances of stock, creditors, debtors, cash balances given to us. Percentage of gross profit on turnover has gone up from 20% to 25%. Ratio of net profit is from 15 to 16%. Okay. Portion of fixed asset was very old. Uh, uh, so portion of fixed asset very old, and book value 1,80,000, disposed of at 90,000. No depreciation to provide on this item. Long-term investments were purchased for 2,96,600, and bank OD is fully discharged. You have to prepare balance sheet for both the years. I mean balance sheet for 2023 as well as 2024. You have to prepare balance sheet for both 2023 and 2024. Would you like to solve it? First, can we prepare the balance sheet of 2023? Balance sheet of 2023. Can we prepare it? Yeah. Can we prepare the balance sheet first of 2023? First, focus on 2023, then we'll look at 2024. Right. So just try to solve it in rough way. Cost of sales, most of the things are given to us. Current ratio, working capital. Okay, I mean, this much time is sufficient. Yeah. Prepare the balance sheet of 2023, guys. Are we done? Okay, so let's look at the solution quickly, guys. Okay, so this is the first part. Then let me just show you the remaining part. Okay, so based on this, what we have is 2023 is done. Just verify these numbers. You have got a share capital of 20 lakhs. Reserves and surplus is going to be a balancing figure. So it's like if you're getting the reserves and surplus as accurate, you've got the other part also accurate. Then we have got the P&L account also, which is 15% of sales, bank OD, and the creditors, right? So first of all, for 31st March 2023, we need to calculate the current asset, current liability, for which we have the current ratio and also the working capital. So let's say the current liability is X. So current assets is going to be 2.5X. So working capital is current asset minus current liabilities. So working capital is 6 lakh, which is equal to current asset of 2.5X minus current liability of X. So we have the X value as 6 lakh divided by 1.5. So current liability amounts to 4 lakh, out of which, of course, the bank OD is 1 lakh. So 4 lakh is the current liability, and then current assets is going to be 2.5 times of the current liability. So that's 10 lakh. So we have the total current assets to be 10 lakh. Liquid ratio, it is liquid assets upon current liabilities. Right? So liquid assets upon current liabilities. So when you have liquid assets, we are going to include only the debtors and the cash bank. So liquid assets is going to be amounting to liquid assets is 6 lakh, which is equal to current asset minus stock, right? So we got the liquid assets. So current assets minus stock. Liquid assets, the stock is going to be 4 lakh, and the balancing figure is going to be the cash at bank. Okay, so stock is 4 lakh. Now fixed asset calculation. For that, we have the fixed asset proprietary ratio, which is fixed asset ratio, net fixed assets upon the proprietary funds. So our net fixed assets upon proprietary funds is 0.25, right? So fixed asset will be 18 lakh. Sales is going to be, as given in the question, cost of sales is 14 lakh 40 and COGS is 20%. So of course, this cost of sales is representing 80% of the value. So cost of sales is representing 80%. So 14 lakh 40 divided by 80. And debtors is going to be 2 months. So 2 by 12 into sales. The debtors will be 2 lakh, 3 lakh. Net profit should be 2 lakh 70, which is representing the 15% of the sale value. Okay, now that is about 2023. Now for 2024, we need to first get the value of sales. Value of sales will be 18 lakh, which was 2023 sales, but now it's going to be 20% higher. So 18 lakh, on that you're going to have 20% higher, so which is 21 lakh 60,000, right? And then we go ahead with the calculation of fixed asset. Now that fixed asset can be computed by simply preparing the ledger of the fixed assets, guys. So ledger of fixed assets will have your opening balance of 18 lakhs, which was the previous year. We have made a sale of fixed asset also. A portion of fixed asset was sold for 90,000. So which was having a book value of 1 lakh 80, it was sold for 90,000. It means there's a loss on sale of 90,000. So that loss on sale and the bank value. Then we have the depreciation. which is going to be the same as the previous year, which is 5%. So we have the P&L, which is depreciation, and the balancing brought down is 15 lakh 39,000. So total is tallying at 18 lakh. So we got the fixed asset value as 15 lakh 39,000. Okay. Then the other part we have like stock, creditors, debtors, cash balance is directly given to us. So we're just going to post them as it is. Then bank overdraft is fully removed. Long-term investment is again given to us to be 2,96,600, right? Long-term investment is given to us 2,96,600, and this is given to us. Share capital remains same. Reserves surplus remains the same. Whatever is the P&L profit and net profit for the year, that's 3,45,600. So 2,70,000 plus 345,600 is added to make it a balancing figure of 6,15,600. And then creditors is already given to us in the question, guys. I mean, creditors is 4,15,000. Okay. So balance sheet is telling it 31,60,600 for the year 2024. Okay, so that's the solution for this question. You can just take a screenshot if you wish to keep it. Because the second year, which is 2024, the calculation is pretty simple because most of the values are given to us. We're supposed to calculate only a few values out of it. Okay, to a screenshot. Then you can take a screenshot of the question also. Done, guys? Well done. Okay, great. So this one was quite a challenging question because we had 2 years to compute. One is 2023 and then also 2024 because but 2024 was comparatively easier because we had most of the values of current asset, current liabilities, only a few of things which is fixed asset, and the net profit was supposed to be computed. Otherwise, it was pretty easy. So if you have any queries, you can just come up with it now, and then we can just call it a day. Any queries, guys? Answer part. Okay. Here is the solution part. Are we done, guys? Okay, fine. So as there are no queries, let's just call it a day. We'll meet up again next Sunday, guys, with the next topic to be revised. Okay. All the best, guys. Good night. Bye bye.
That's Sadanova.
Yes, 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 sir.
Okay. निसर्ग जी, कैसा नंबर?